Hello, everyone, and happy Friday. This is Marie from MarketsFlow. It's the 6th of September, and we are nearing Friday evening as we bring you this weekly performance for the week ending September 6th, 2019. I'm joining in for Tom today, and I will be taking his place as a moderator for this web chat. Adam will be speaking about this week's performance. Hi, Adam. How are you today?
I'm fine, thanks, Marie. Trying not to look out of the window because it's a sad reminder that the summer's over. Much better to keep looking at the screens because the market is less depressing than the weather.
Oh, well, let's focus on the screens then. So let's get started. This is Webcast 19 for MarketsFlow's portfolio performance for week ending September 6th. Our web chat is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. We are also SEC authorized. Your deposits are protected by the FSCS for up to £85,000. Before we start, I would like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. Right, with this important information shared, let's cover the all-important subject of how did the portfolios do?
Well, up to now, and we're partway through Friday as we speak with a couple of hours to go before the market closes. I can tell you that as of now, high growth is up 0.59% this week, and that translates to being up 4.97 since the launch of accessible portfolios at the start of June. The growth portfolio is up 0.32 this week and up 4.86 since that same launch date. And in the case of the ISA portfolio, up 0.16 this week and up 3.33 since the launch.
That's great. And how has the market as a whole performed this week?
The market sort of continued its journey back towards calm and stability, at least on the surface. The moves at the aggregate level, market indices, became smaller and less choppy, and it was possible to discern a mostly upwards direction in the market over the week, gently creeping up, which at the time of me saying this has risen about 1.8% relative to last Friday's close, maybe just a touch more. As you'd expect in that environment, volatility fell, both actual and implied. So it was somewhat similar to the story of last week, but moving further in that same direction of calm being restored. But some of the days of this week, particularly yesterday, I think of, it felt as if we were very much back in that old dynamic that we've spoken about several times on these sessions, where if you look at the surface of the market, the aggregate, if you just observe the S&P 500, for instance, you'd see something that is not moving very much most of the time. Normally, there's a relationship between that stability on the whole and the price action of the components inside of it that comprise the index. Generally, there's some reflection on the surface of what's going on underneath. But with this particularly odd regime, we see exceptional dispersion between the best and worst performers within an index in each period or each day, or even if you looked at a 1 or 2 hour period, you'd see them darting up and down all over the place compared with what would normally be expected in a calm overall market, which is that the components would also be relatively calm. So that's the sort of characterization of the week.
Okay. Well, thank you. And so what was the allocation within the portfolios then?
I described this week overall as being one of moderate allocation levels, viewed in the context of our own history of how much we tend to be allocated. Some of the activity was in stocks, some of it in options. Our signals didn't start the week particularly optimistically, but they came a bit more positive towards the end of the week. And in retrospect, I'd rather they'd been more bullish sooner, and we might have been more inclined to allocate more heavily to this market. But with declining volatility, the attractions for riding options were in many cases not that interesting. And as we weren't supported by particularly bullish signals, we just had a moderate overall level of allocation.
And has the increased price action under the surface you were referring to, or dispersion, meant better opportunities to make money through active management?
It was a great question. It ought to mean that good stock picking is more strongly rewarded. That's what dispersion ought to mean. But if you think about the three main areas that we can make money through with active management, varying our allocation to the market as a whole in a timely fashion, we could call it beta timing. There hasn't been much opportunity for that because the market as a whole has just been very calm and just gradually drifted upwards. So buy and hold would have been best. And that's not really active management. Another area we try to generate some return is through writing options, and with low to falling volatility, the reward for doing that's been limited. And yes, in theory, the low vol but high dispersion market means it should be favorable for stock picking. But even in that field, the moves have been kind of choppy, often reversing quite quickly too. Not many strong trends forming at a stock level. So in practice, that has felt like a difficult one to play as well.
Mm-hmm. So what do we look forward to from here over the next week or two?
Well, if the speculation out there is right that there's reason to be optimistic about the trade and tariff dispute, that's possibly a mover of markets. If the markets are in such a mood to feel good about that, but to the extent that the stock market is also looking to the Fed for monetary support, when you have a geopolitical or other type of risk like that, you have that risk recede, which is surely good from a macroeconomic perspective. You may find that expectations of the Fed's generosity also start to dwindle because there's less reason for the Fed to rush in support. So that might be a double-edged sword in some respects. I mean, it'll just depend on the market's mood. And it doesn't necessarily translate unambiguously to a big positive for equities. Aside from that, there'll be a continued focus, I think, on the gathering evidence or not of various economies moving closer to recession, and the various moving sort of market factors that are affected by those expectations. But when it comes to those things that are important to us, we just have to remain aware of catalysts that can set the market tone from day to day. And as always, we focus a lot on watching for the behavior of the dynamics of market behavior day to day.
That's great. Thanks, Adam. So this brings us to the end of today's web chat. Thank you for all the information about portfolios, Adam, and we'll be back next week. In the meantime, thanks for watching or listening to us on YouTube. Please remember to subscribe to our YouTube channel. Have a great weekend, and we look forward to our next Friday's web chat. Take care.